This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
JP.
Good morning, Louis.
How are you?
Excellent. How are you?
Got my cup of coffee? Yes. Today we're going to be talking about getting out of your own way. So when I look at all the news that's going on right now, it really got me thinking about, what did we want to talk about today? And I remembered that a while back I had written this little chapter called Your Millionaire Mind. And in that chapter, I was talking about the most common, like the 5 most common problems that how people are getting in their own way. And it really reminded me that we really need to get out of our own way, especially right now with all the news that you're hearing, and it kind of spurs these flaws. So if you don't mind, I'm going to read the first paragraph of, this is from the Financial Freedom Blueprint, the first paragraph of this, then we can kind of riff on each one of them. There's 5 we'll go through real quick.
Go for it.
All right. It says, people don't want to admit their faults, but only good investors recognize them as soon as possible. It's not natural for most of us to seek our own faults. It requires a complete shift in our mindset. And that's what I want to talk about today is mindset. Scientific evidence proves that we tend to make systematic mistakes regardless of our intellect. Doesn't matter how smart we are. Professors and scientists in academia have developed an entire field of study called behavioral finance. So they have found human judgment can be seriously flawed when it comes to investing. An evidence-based strategy helps you become aware of these mistakes so you can become more rational with your choices. Here are the 5 most common flaws. So I'm just going to run through the first one and let you riff on it, all right? Mm-hmm. First one is herding behavior. The tendency of an individual to mimic the actions of other people, whether those actions are rational or not.
Oh, bam. Okay.
Go.
That's no, I totally agree with the setup. And if somebody cannot relate to that mindset right now, I don't know what will, because I think with everything that's going on, it's really easy to become emotional about investment and step away from maybe being a little more pragmatic and fact-based. It feels good, right? As an investor, it feels good to go where everybody is, right? So you have, pick your favorite right now. Like what is, it feels good to buy a stock that everybody owns, that you show up at the cocktail reception, which there is none right now, but anyways, you can still talk about stocks. You own your hot stocks and it feels good. And this may be, what is fueling that, that self-fulfilling prophecy. Now, one thing
hold on. So you brought up that it feels good, right? I mean, that's kind of the main thing. It feels good. So it's like the herding behavior comes back to that sheep, analogy with the sheep. I think Michael Covell, he has a podcast called Trend Following. He did a video on, actually went to a herd of sheep and showed how they react, and how when one does something, the other ones do, they just all kind of follow each other, and they'll follow themselves, to their death. So that's kind of the basic issue here, right? And it could be in lots of different mistakes, but that concept. And so what would you say is the easiest way, or what is you mentioned evidence-based, which is actually the title of this chapter in the book. This is part of that chapter. So what would you say the antidote, what is the medicine you should take to try to avoid herding behavior?
Well, I can think of 2 things. One is to, of course, do your homework, right? Like we do all the time, whether it's somebody else doing it for you, or whether you outsource that or you do it yourself. Like, when it's tempting to do what everybody else does, but do your own homework to see if it makes sense for you to either buy a stock or do whatever you feel the herd is doing. So, and the second is to know that you have a rationale for that action, right? And we can benefit a lot from, behind that herd behavior is a lot of, you can say it relates to momentum and trend, and yes, we benefit from that. but not at any cost, right? So we want to take advantage of that, but to the extent that we have our own reason to be partaking into that direction, right? And at what time you should be jumping off the wagon, right? It's great to get on the train, but you need to know what station you're getting off at, right?
Yeah, there's two quotes that I think really fit this. Benjamin Graham, the father of value investing, he said, "You are neither right nor wrong because people agree with you," and that's true. And then the other one is my favorite quote on this is Milton Friedman. Milton Friedman, a great economist. He said, "The only relevant test of the validity of a hypothesis is comparing it with your predictions, comparing your predictions with actual experience." Hi, if you like this information, be sure to subscribe to our YouTube channel, hit the like button, also share it with your friends. And to get the free report, the 10 avoidable surprises that derail executives planning for retirement, go to retireready.live and get your free copy. So herding behavior would be the first one. I would say let's move on to the second one because we want to cover some ground here. The second one is overconfidence. Overconfidence can lead us to trade too often or invest too heavily in a particular asset. We're self-assured of our superiority. Not everyone can be an above-average investor, yet we all think that we are. This can lead people to trust their gut rather than do their homework. Believe it or not, many times a gut feeling is not a good source of decision-making. Go.
Oh, this one is too much fun because we all taunt our successes and trying to downplay our failure, like you said, and this gives us kind of this overconfidence. I'll jump to maybe the antidote or the solution for that. It's a question of having a process is to really to measure risk. What is the cost of being wrong, right? I mean, if we all hope to be right, and that's great, but what is again, I force ourselves to think about the possible downside. Yeah, and we talked at length at this. It seems to come up every week, and it should probably about sizing opportunities appropriately according to their inherent opportunity as well as their risk. And if you think you're too emotionally involved or engaged in those decisions for yourself, maybe the idea of having somebody give you advice for it might make sense because you take away a little of that problem, right?
I mean, we see that a lot where somebody comes in and they are like really knowledgeable, maybe even were former and worked in the industry, and they go, you know what, I just don't have, it's just not, my personality doesn't fit it. I need you to use the discipline. All right. Before I go on to the third one, I was going to mention to you that we send out a monthly market insight, and it's a video, and I noticed that a lot of people are really liking it. So I wanted to just let anybody who's watching this know you can get this monthly market insight. It's actually a video that shows graphically what's happened in the market over the last month and what we see happening in the various markets. And all you got to do is go to our sign up for our blog. So if you go to wealthnetinvest.com, there'll actually be a little pop-up that comes up that asks you if you want to sign up for the blog. So you can do it that way. And I'll also put a link here as to how you can also get that, just a separate link. But so yeah, go ahead and do that if you want to see those. Prospect theory, by the way, is the next one. This is probably my most favorite heuristic, or not heuristic, but problem, behavioral finance problem for investors, because when I learned this one, this changed my whole life. And prospect theory is the phenomenon that leads to investors making poor decisions. Our brains are hardwired to hold on to losers too long and to sell winners too soon. So Daniel Kahneman and Amos Tversky developed the prospect theory in 1979 when the research found that people do not value gains the same as losses. The evidence suggests that we want to hold on to our losers to avoid to avoid regret, that feeling of regret, and to circumvent the pain of admitting a mistake. Oh, people don't want to admit mistakes. That is so hard for, especially value investors. I've found people that have that kind of a feeling in their brain, in their like core. They don't want to admit mistakes. On the other hand, it's easy for us to take a quick gain. When you're up a little bit, it's like, boom, take it. You want to take it. So this is the exact opposite of what all the research that we do shows you should do, right?
Yeah. I mean, this one we all guilty of. And I mean, personally, like this was very heartfelt when you read the definition of that thing, which is, the way I kind of reconcile that for me, and I remember I was like, the market does not owe me anything, right? And that's what, like, hanging on to you losers, you think the market owes you something. The market does not know your cost basis, does not know when you bought it, why. It does not care, right?
The market does not know your cost basis. I love that. I'd like to get that on a t-shirt too. We could start a t-shirt company, I'm telling you.
That's a good idea. So so for me, that was kind of that moment. However, you come to that realization that that this is the situation, and also distinguish a good company. Let's talk about stocks here again, as we do. It's a good example, but a good stock, a good company versus a good stock. Those are two distinct things. You can have a great company that is really not a good stock to own right now. You can pick your favorite. Like Apple was not always a great stock. It has gone down 50%. Certainly was not a good holding, even though it was probably still a great company. But so if you're able to say that, so that gives you, like, to be pragmatic. That means, like, you have a list of companies that you like. You're like, those are great businesses. And then sometimes you own them, and sometimes it's time to get out. And it doesn't mean that you can't get back in, right? For some reason, we associate sometimes selling with said, oh, I don't like this company anymore. I shouldn't like it. Like, it feels weird to get back in. And
who hit that home the hardest for me? That whole concept of separating the stock from the company. Ralph Acampora.
Mm-hmm.
I was lucky enough to do a talk with him over at DU. They had the finance forums. You remember those? I think we still do them at DU.
We hosted that. I hosted that. Yeah.
Yeah, and so it was pretty cool. I got to talk after him, which is kind of hard because he's like an amazing speaker. So, but anyway, I got to talk after him, and then later on we did a little group. We went to one of the classrooms and we did a course for some of the students. I think there were a mix of grad students and undergrad. And anyway, and he drew this big circle, and then he drew a line through the center, and he put stock on the top and he put company on the bottom. He said, okay, you got the company, they've got earnings, you got the management, and you got all these things, right? But here's the stock. And what we're going to be talking about today with technical analysis is the stock itself, the supply and demand for the stock. And ever since then, I've kind of used that as he's really brilliant about explaining that.
I think it's in the pitch book of the CMT program now, that particular circle. Yeah.
Yes, the circle
was very influential with the CMT.
Yeah, of course, he's one of the founders. Him and another guy, Brooks. Brooks was his last name. I'm trying to remember his first name. John Brooks, I believe. John Brooks. In fact, I met John Brooks. He came out to speak years ago here when I was the president for the Charter Market Technicians Association here in Denver. And we used to go up to Prudential Bache's office up on the top of the cash register building. And he came in and he was like disheveled because he'd been, talking to people all day because he worked for an investment management company as a technician. He comes in with his suitcase rolling in and just lit it up. He's a great technician. He's missed for sure. He's no longer with us. Okay, the next one, overreaction, is the tendency of people to overreact to news information. I think this is the most applicable problem right now, where people are overreacting to news. Trump gets COVID. Oh my God, sell everything. Just you pick the news headline. Mm-hmm. And actually, if you had reacted to any of those things, you really got hurt, right? How many times are we swayed by the financial news or some other media? In many cases, this leads investors to buy or sell immediately without knowing the facts or estimating the consequences. And there's a lot more on this. So what do you have to say about overreaction?
This is one that a lot of people are making a lot of money on this. I mean, this is the idea of shoot first, ask questions later, right? So you just said, okay, I don't want any of this. There's bad news, and I'll figure it out later. But I don't want to be in all of this bad news, and that's something that is actually taking advantage of. Those are kind of those heuristics, those systematic mental pattern that even people like, of course, primarily those algorithmic traders can take advantage of in the market, right? They're able to detect that the market is in a kind of an oversold position, overreacted to some news, and basically maybe beyond what is rational to it. So, and we, you can hurt yourself definitely by reacting to that. And right now in this day and age where we're flooded with information, actually information is a bit of a misnomer with noise is what I call it. You have to be able to distinguish noise versus information. For example, we own Goldman Sachs. Goldman Sachs reported earnings this morning. That is a piece of information that is quantifiable, that affects my view, my opinion of value on a stock that I own. In this case, it was a very happy event for us this morning.
Oh, good. What happened with the stock?
We own the strong one. Bank of America got crushed. Goldman was up, doubled its profits, doing very well in this environment.
Yeah, they've been doing the right things.
Yeah. So anyway, so this is a piece of information that I react to. But the fact that some bloggers yesterday tell me that Goldman Sachs is the worst, is the evil empire and blah blah blah, I don't care, right? I mean, this kind of gymnastics, if you're in the market every day, you get to develop this. Maybe it's an instinct, but I mean, there's only a few data points that we really care about. Most of it is noise, and we, so. And it's interesting. I mean, to get a little more maybe technical on this stuff, right? Every stock has a normal amount of volatility, right? We talked about volatility, which is normal, right? This is noise, and you should not be trading on that noise. This is the sure way to lose money, right? So you should know what is a move, what is an action that is actually outside of that basically said, okay, there is something going on here, whether you know what's going on or whether you said, well, am I missing something, and what is that?
Well, we certainly try to know. We don't know for sure what's noise and signal always, but yeah, it's hard sometimes to distinguish. And I will say that if you look at the volatility characteristics over the years, you'll see that there's more noise now than there used to be. Like, for example, the trend followers used to have very short parameter sets in their breakouts and their moving average crossovers and all that, and they made very good profits doing that. But now they've had to lengthen everything up in terms of how long their breakouts are, because there's more noise in the market, and the more established a market, the more noise you tend to have. Like equity markets tend to have a ton of noise relative to, say, currency markets or fixed income markets, which have less noise. And how do you know that? Well, you can quantify that. There's a gentleman by the name of Perry Kaufman who created this concept of, it's kind of like a signal to noise ratio. It's been called that. But basically what it does, it says, okay, I'm going to look at a time frame, pick your time frame, whatever it may be. Let's say it's a quarter. And we're going to look at the absolute value of all the changes every day during that time frame and add it all up. So that basically, that's the total movement that market made during that time frame. And then you compare that to the actual move made from point to point in that time frame. And so if it was a perfect straight line, you'll get a number 1. If it's just completely noise, you'll get a number 0. So that is a great understanding. If you look at that measure, you can actually see that, yes, in fact, quantifiably, equities are more noisy. And in fact, equity noise is even more pronounced in the large caps. And a lot of this has to do with just everything going on with indexing. You know, I heard a statistic that blew me away, and I have to verify this, but I heard that the market is now at 43% indexed. And if that's true, which this is a pretty good source, then that's telling you a lot, right? That's telling you that there's a huge liquidity issue that's brewing up here, because, you know, all this money is, there's a ton of concentration risk. And Not to get too far off on a tangent, but in the Handbook of Risk, I wrote the kind of the things to look for a potential big shock. And we've got all sorts of big shock things happening right now. One of them being concentration risk with few institutions, Vanguard, the indexing. And I've noticed that with the liquidity, you could even buy a big, huge company like Apple, and you can go in and you'll notice that there's not as much liquidity because most of the volume that's happening there is on the buy side because it's all indexed. Everybody keeps plowing their money into the 401ks, et cetera. And so you wind up having to be very careful for us to buy $1 million of Apple.
Mm-hmm.
So it's anyway. Now we got I got off on a little bit of a tangent there, but I do think the noise situation as a whole, we could literally do an entire thing on noise. But since we don't have that much time, let's move on to the next one. Recency. Recency describes the fact that we are prone to place more importance on recent information rather than older information. This is a problem because something that happens today is not necessarily more important than if it happened last week or the week before. And new information is so fresh in our minds that we don't see the full picture. And as we will discuss, evidence-based approach helps you with this error of judgment, blah, blah, blah. So tell me about this recency thing. Has that, I know I fall into this recency thing.
Well, I mean, I
think on that?
We've seen an amplification of that problem in recent years where, I mean, last week's news feels like a year ago now. I mean, before at least, we had a few days to digest something. Now it seems like the news cycle is feeding us the next breaking stories, every few minutes. Before we even had a chance to process the past, and that's what that's again maybe goes back to the whole idea of noise, because as you mentioned also I think it was the first one, you said you need to look at to have a plan to compare your forecast to the actual. That's how you know if you're right or wrong, right? So let's say I'm getting into a stock today. I probably have an opinion of what that stock is worth. I have an opinion of what the company is capable of executing from a fundamental standpoint, right? We have to have those assumptions into our investments. And then, you get to check that. Like, for example, Goldman Sachs that I just used is that. Like, I was expecting, things to go well on the issuance of debt and IPOs and stuff, and that's what's been fueling the earnings. So, this thing, which, when we took the position, we had a view, and then this is kind of either confirming or disconfirming, if you will, of our thesis, if you're on the right side. Again, it's having that memory, right? I would say you need memory of your decision making, and how do you go back to assess, as opposed to say, oh, I don't even remember what I liked about this company, and now there's like a bit of a negative sentiment around it. And
yeah, you nailed it on the head. Memory. That was what was going through my mind the whole time, because that's the beauty of computers is we could tell the computer to remember stuff for us. It's really good at storing information and filing things and keeping us honest with ourselves. So having a quantitative approach is so important, because you can actually quantitatively see how much memory should we have. One example would be if you're looking at relative strength trends in price. Well, we know that if you have a really, really long memory, that it tends to be, the stock prices tend to be mean reverting. But if you have more of an intermediate term, it tends to be more continuation of the trend. So but computers and having that memory is so important, because our brains are so flawed. I mean, how we experience things and how we remember and store things are not the same as to what actually happens. So that's very good. Well, so we did a good job. We went through all five, and we're pretty good on time. So I don't have any final comments really. I wanted to kind of just knock this out, and hopefully people can get things. Other than to hey, I just remind you again to like and subscribe our YouTube, and get our blog, and you can get things in your inbox as well. Get notifications when we go live too. So when we're on Facebook, you can just click that little button, and you can get notifications when we go live. So, all right. Thanks for joining us. We'll see you next time. Bye-bye now.
Have a great day. Thank you.
The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals. If you like this information, be sure to subscribe and follow us on Twitter and Facebook.